Okay, I'm going to have to go really quick. So what was important to us, and this is something you should always look at for companies, you know, you can drill and drill and drill and get good results and year after year. If you don't put it into context, to me it's a red flag. You need to show what is all that drilling accomplishing. Well, to do that, you put together a resource estimate. And the resource estimate tells you all that drilling, how much gold have we found to date. And so in the old company, we did it every year. We thought in this one, it's great. It's very, you know, it's kind of full disclosure. This is how the project is doing. So in February, we came out with our first one. It was probably about 12 months of drilling, so our kind of annual update. And we started calculating. We did very well. So with 80,000 meters of drilling, we basically doubled the resource. We went from just over 700,000 ounces to 1.4 million. Now, and this graph, this chart shows the different ounces. So we've got open pit ounces, underground ounces, and then the total. Now, what's really important too is there's different classifications of ounces. And so you have less confidence to more confidence. When we got this resource, it was in the least, kind of the lowest level of confidence, which we call the inferred resource. Inferred is, it's probably there, but you better do some more work to prove it's there. And so when we got it, we had to prove a lot. In this resource, we took half of the 1.4 million ounces. Essentially what we did is we took the first 700,000 ounces and we upgraded them to the more confident category, which is indicated. And that was a lot of people really, I think for them, it was as important as the doubling of the resource is that we built more confidence. And so now we have a large indicated resource. And so overall, very successful first year of work on the project to start building that trajectory that we have to the 2 to 3 million ounces. And so if we take our data points, we're on a growth path to get to that size that we're looking at. It's just, you know, another year of drilling. Next February, we'll come out with another update and we'll show that progress as we go through. This, you know, I guess this is just to elaborate on that, is looking, started with 770, we're now at 1.4. Basically, 2019, we want to show you what was our progress through the 2018 drilling program. End of October, we'll say, okay, that's the last results that go into the calculation. February, we'll come out with a new, and obviously looking at that trajectory to that 2 to 3 million ounces. Another important thing is the low discovery cost, and that's a very important. It's only costing us about $10 an ounce. So the exploration dollars that we put in, we're getting a very accretive value return on those on that exploration spend. And of course, Val-d'Or, one of the cheapest places I've ever worked. In my entire career, I don't think we've drilled at a price this low. So very good return on kind of capital spent in this particular area. Now, big milestone for 2017. Ivan, how am I doing?
You're doing very well.
No.
The truth of the matter is I'm loving this, and we can ask questions later, but I think you need to continue because
Okay.
I'm very excited.
So one of the big milestones, geological model. And that was a critical thing. When we came in, people didn't understand what the geology was. How do you follow gold unless you understand what all your structures are? This image, this is a 3D image of all the gold structures. We've got vertical structures, we've got the gold veins running through it. But what it really showed was we have a mass of gold-bearing structures. And this is why one of the things that we can do is in the upper, let's say, 1,000 feet, we can take all of this massive gold in a open pit. Very cheap mining, very easy to do, and the fact that we've got so many high-grade structures, the density of those structures allows us to take it out as a bulk tonnage open pit, very cheap mining, and that, you know, is where we want to be at that 2 gram plus kind of cutoff, because it becomes very profitable to mine open pit at grades above 2 grams. And so a very kind of critical step was to understand it. Now that we understand it, we realize there's a whole bunch of places where people haven't looked, where we can expand this gold deposit and really kind of build that resource to the size or more than what we were actually looking for in the first place. And that is probably highlighted more here. So now this is what we call a long section. So if you think of it, I got this big mass of gold underneath the earth. I need to look at it. So I take a slice through, kind of a vertical slice, and now I'm looking at that vertical slice through the gold deposit. So what we've got here, all of the gold veins are kind of these yellow structures. We have these vertical gold structures that we call diorite dikes, and they all contribute to the mine plan. And so they're all gold structures. Now, what you'll notice, remember I said the company that we got it from didn't do any exploration, or not the company we took over started exploration. The company who mined it didn't do anything. So nobody really had a clear idea of what the scale of this project was. We came in, started putting it all together, realizing there were all sorts of gaps. We think there's a very good potential to start connecting up all of these deposits. So basically the resource here, we can see the open pit that the conceptual open pit, take out all this gold in the upper 1,000 feet, other pits here. But if we can coalesce or connect all these things together, we start building a bigger open pit and we start taking out more gold. And that's really kind of the key, and that's what Yves is really, he's not just a nerd, he's actually critical to this, to kind of extracting the value out of all of the stuff that we're finding. So on the next one, so now we're going to look at that long section. That long section now in plan view, and this is where things got really exciting. And this is what I love about this project, very much like our old project. The more work we did, the better it got. And that's a hallmark of what could become a very successful project. So the more we invest, the more value we unlock. And that's what's happening here. So now what we're looking at just a plan view map, and the pink are where we have the gold resources now. As I said before, there's all sorts of gaps here that nobody's ever done exploration, nobody knows. We think there's a very good potential to join all of those up and actually build a much bigger resource. Originally, we just thought of building 2 to 3 million ounces here. Now we've got a really long strike length. But what's exciting, and remember, geologists hadn't really done exploration here. Our geologists are going out, we're finding, initially we thought, okay, well, it's going to be a narrow corridor of gold mineralization. We stepped outside of here, on surface, we're finding new gold mineralization. And what's happening is that we're expanding that entire model. So there's more potential for gold in more areas than we initially thought. And that's why I say it's exciting, because it is actually getting better as we do more work. And this is just, okay, this is a geophysical map. So one of the tools that we use when we find, where do we dig? Well, we use surveys that show us the best place to put the drill to hopefully find gold. So let's say signatures of gold mineralization. And what we've got now is, this is the original mine signature, much bigger than we thought, and then we found this. This is kind of a similar signature, and all the way to the south. What's really important, we came down here, we tested this new geophysics, and we made a new discovery down here to the south. 7 grams over 12 meters at 300 feet depth, which is a really high-grade, interesting discovery. If somebody had a look before, they would have found it, which really, proof of concept, this gives us a lot of exploration upside, because nobody has ever really looked at it before. And on that, I will leave it to Yves to kind of go through the second part, which is, how do you unlock the value from the gold that you find?
So David has squeezed me a bit, so I'll have to go to the essential. I don't have a lot of time. So I would just like to do a bit of recap. So this is what you see here is basically the resource in 3D, and the various deposits that we've seen from plan view. So we started with 700,000 ounces. We drilled 83,000 meters last year, and we've doubled the resource to 1.4 million. And of that 1.4, there's 800,000 that are in the open pits. And so I'll give you my concept of development, but there's also one thing that I would like to recap is one of the learnings that we've had when we did Pro Mines is that if you're thinking about building a project, you don't take the shortcuts. And that adds value for if you're going to build it or if you're going to be acquired. because the quality of the work that you're doing in de-risking the project helps any acquirer at eliminating some risk when he's evaluating the project. So, we've seen the 800,000, and we've seen also that in the intersections, not the intersection, but in between, there's a high potential that rather than having multiple open pits, we're going to have one open pit. So conceptually, it would be a plant of 8,000 tons per day from one open pit or multiple open pits, ideally one open pit. So everybody will tell you that their objective is to have low capex and low opex, and grade is definitely a prime contributor. But there's not only grade. I mean, grade has to be taken in context. 1 gram per ton in a heap leach, because of the processing cost is so low, can become extremely profitable. I can give you a 10 gram per ton. If the metallurgy is not good, if the ground condition is not good, if it's in a remote location, if it's skinny, it's worth nothing. So it all has to be taken into context. So with 2 grams, with 2 grams, we are moving towards the low OPEX and low CAPEX. Another feature of the studies that we've been doing to de-risk the project is sometimes the gold is locked in the crystals. So it becomes extremely complicated and costly to extract. The Val d'Or ore is very simple. We call it free milling. And we've done some, the Cambior mine had 93% gold recovery. We think with a simpler process, we can get to 95, even 97%. So meaning that every 100 ounces that you feed into the mill, you're going to extract 97% of that, 97% of that gold. Another aspect that helps in your cost is the quality of the rock. So if you have poor quality rock, you can imagine that you might have an open pit where you basically have to mine the total earth to get the deposit. In Val d'Or, here we have ground conditions that are so good. We have pit slopes that have been engineered at 60 degrees. And typically, open pits are between 45 and 50 degrees, so the slope of the sides.
I'm so sorry for this. I know that the worst thing I ever did in the world was cut our meeting down to 3 hours. It should be 6, only because it's so interesting and we don't want to stop it. But I just want to be able to have all presentations, so if you could wrap it up.
Okay. So I'll just go straight here and here. We've done also some environmental evaluation to see if the project has some issues, if there are some special habitat that would prevent some zones of the deposit to be mined. The answer is no, there's no species at risk. Also, sometimes when you develop a project with rain, metals, and the contact of the water and the ore will create acid leaching and metals leaching. That creates some issues. We don't have any issues here. So it's a non-acid generating and non-metals leaching. And we talked about the proximity to labor pool, but we have a drilling cost this year of $92 Canadian. So that's an indicator that you can see that the benefit of being close to a labor pool, $92 Canadian, that's just a bit higher than $70 American, which is more than half of what you would see in the US, more than a third of what you would see in remote location, and the lowest that David has ever seen since the beginning of his career. So the proximity, everybody talks about the proximity of the infrastructure, but the proximity of the labor pool, the proximity of the contractor, you can see, we can see it by the cost of our drilling and our discovery costs. So maybe I'll stop there, David, or do you want to wrap up?
Yeah, we'll maybe go to the last, we'll just go to the last slide. And really, I guess looking at this, it's all about finding projects where you can extract the maximum value for shareholders by, ultimately checking the boxes of what we've been talking. What are people looking for? What are companies looking for in a project? What makes it attractive? And I think that's what we've done with this. Oh, sorry. Yeah,
Whoops.
Oh, there it is. is really about, checking those boxes so that we do become attractive. And I think one of the things that we have to remember is that, the markets, we have no control over those right now, gold price and the disconnection between equities and gold price. But what we're doing, and I think what every company at the table is doing, Dalradian, Northern Empire, it's about setting ourselves up to be, the front pack of companies. When things do turn around, we're going to be the first ones companies look at and people say, you know what, that's the next takeout target. And that's where value is created in the market, and that's where share prices go up, is when we've done that. And I think by checking these boxes, district scale potential, track records, people trust us, treasury, low capital structure, strategic investors, validation, big resource, good grade, and executing these milestones, and keeping at it, advancing this project. Even if the market is saying, we're not going to give you value for it, you just keep pushing ahead, because when it turns, we want to be at the front of the pack and really kind of be the company or companies that people say, those are the next ones to get taken out.